You open your phone, launch Robinhood, Binance, or Fidelity, and stare at those flashing green and red candlesticks. One minute your account is up a few $100s, the next it's bleeding red and everything's gone. Your heart races, your palms sweat, and you wonder, is this really investing or just high-tech gambling? That's the vicious cycle millions of Americans are stuck in. We get obsessed with buy low, sell high every second, chasing the waves of Bitcoin, meme stocks, or the latest hot picks on Reddit, only to end up sleepless, stressed out, and sometimes completely wiped out. Benjamin Graham, Warren Buffett's mentor, left us with a timeless truth. Smart investing isn't about guessing whether the next candlestick will be green or red. It's about having a method, discipline, and a long-term mindset. The intelligent investor doesn't teach you how to get rich overnight. Instead, it teaches you how to avoid stupid mistakes, protect your hard-earned money, and steadily build real wealth. And if you've ever asked yourself, how can I invest without living in constant fear every day, this video is your answer. Hit like and subscribe so you won't miss any financial lessons that could change your life. Part 1. The two types of investors: defensive and active. Benjamin Graham begins the intelligent investor with a very clear distinction. Every investor falls into one of two groups: defensive or enterprising, active. This isn't a label, but rather the path you choose depending on your time, personality, and financial goals. The defensive investor values safety, low risk, and doesn't want to spend hours analyzing financial statements. These are people busy with full-time jobs, family, and everyday life. For them, investing isn't about proving intelligence, but about protecting and steadily growing their wealth. The approach here is broad diversification, focusing on index funds like the S&P 500 ETF, along with a portion of government bonds or high-quality bond funds. For example, imagine an office worker in Texas who consistently puts $500 a month into a 401k invested in index funds. He doesn't care if the market is red or green today, but 20 years later, his portfolio could be worth over $1 million. That's the power of the defensive path: simple, patient, and effective. In contrast, the active investor seeks to beat the market. They spend time researching businesses, analyzing financial reports, and comparing intrinsic value with market price. But, Graham warns, being active isn't about day trading, chasing trends, or jumping on meme stocks. True active investing means uncovering opportunities others overlook, buying stocks when they're deeply undervalued, and always respecting the principle of the margin of safety, which means only buying when the price is significantly below intrinsic value to reduce risk. For instance, instead of chasing Tesla at peak prices, an active investor might quietly buy shares of a small medical equipment company with steady profits that the market has ignored. That's the essence of active investing, according to Graham. The core difference between the two approaches lies in time, effort, and discipline. The defensive investor optimizes for simplicity, safety, and minimal time commitment. The active investor demands significant effort, deep analytical skills, and iron patience, but in return may achieve superior returns. In the end, Graham emphasizes, there is no single path that's right for everyone. What matters is being honest with yourself. Do you want to spend hours researching companies, or would you rather stick to a safe, low-stress strategy? Choosing correctly from the start will determine whether you become a truly intelligent investor or just another person led by the emotions of Mr. Market. Part 2. Mr. Market, the Moody friend. Benjamin Graham created one of the most timeless metaphors in investing. Imagine you have a business partner who shows up at your door every single day, eager to either buy your shares or sell you his, always at some price he sets. The problem? His mood swings are extreme. On some days, he's wildly optimistic, convinced every company is destined to be the next unicorn, and he quotes high sky prices. But the very next day, gloom takes over, and he's suddenly pessimistic, offering to sell everything at bargain basement prices. Graham's message is crystal clear. The market is not a compass for true value. It simply reflects the emotions of the crowd, sometimes accurate, but more often distorted by greed and fear. A smart investor doesn't chase after Mr. Market. Instead, they learn to take advantage of his mood swings, buying when prices are cheap and exercising restraint when prices are inflated. Warren Buffett, Graham's most famous student, captured this spirit in his legendary advice: be fearful when others are greedy, and be greedy when others are fearful. In other words, when Mr. Market is panicking and selling at dirt-cheap prices, that's your golden opportunity. But when the crowd is euphoric, convinced prices can only go up, that's when you need to be the most cautious. Think back to 2020, when the COVID-19 pandemic hit. Apps like Robinhood, Fidelity, and Charles Schwab were flooded with plunging candlesticks as millions of investors panic-sold airline stocks like Delta and American Airlines. Yet those who had the discipline not to follow Mr. Market's mood and even bought more while others were afraid saw those stocks rebound strongly in the years that followed. In the end, Graham teaches us this: treat the market as your servant, not your teacher. It offers opportunities, but it's up to you to decide whether you'll stay rational or be swept away by the crowd's emotions.
Part 3. Margin of Safety. If Graham had to choose just one principle to define an intelligent investor, he wouldn't hesitate. It would be the margin of safety. This principle means you only invest when a stock's price is significantly below the company's true intrinsic value. In other words, you buy with a safety cushion to protect yourself from unforeseen risks. Graham compares it to building a bridge designed to hold 30 tons, but only allowing vehicles weighing a maximum of 10 tons to cross. That difference is the margin of safety, ensuring that even if something unexpected happens, the bridge won't collapse. Investing works the same way. You can't predict every risk, economic crises, technological disruption, or fierce competition, but you can protect yourself by never overpaying for an investment. For example, if a company's intrinsic value is $100 per share, Graham would advise buying only when the market price drops to around $70 or lower. That $30 gap acts as your cushion, helping shield you from mistakes in valuation or sudden market swings. This principle remains just as relevant today. Look at the tech bubble of 2000. Millions of investors bought .com stocks at prices inflated dozens of times above their real value. When the bubble burst, most lost everything because they had no margin of safety. On the other hand, patient investors who stuck to companies with real value and waited for prices to drop deeply became long-term winners. Warren Buffett, who turned this philosophy into his investing mantra, once said, "Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And the only real way to avoid losing money is by always maintaining a margin of safety in every decision." In the end, Graham reminds us that success in investing doesn't come from the smartest moves, but from avoiding the dumbest mistakes. And the margin of safety is the shield that protects you from those pitfalls. Part 4. Value investing versus speculation. Benjamin Graham argued that the biggest mistake many market participants make is failing to distinguish between investing and speculating. These two concepts may sound similar, but they are fundamentally different in mindset and approach. According to Graham, value investing means carefully analyzing a business, looking at financial statements, profitability, growth potential, and intrinsic value. Then, you only buy when the market price is below its true value, and you're willing to hold the investment long-term, regardless of short-term fluctuations. In other words, investing is a process of making decisions based on reason and data. By contrast, speculation often stems from the expectation that a price will rise in the near future, regardless of the company's fundamentals. Speculators tend to chase rumors, short-term charts, or crowd sentiment. Speculation relies less on value analysis and more on emotion and luck. A clear example is the GameStop frenzy in 2021. Millions of retail investors rushed to buy GameStop shares not because the company had sustainable profits, but because they believed prices would continue rising thanks to Reddit and media hype. That's pure speculation. Some lucky investors made quick profits, but many others bought at the peak and suffered heavy losses when the price collapsed. Meanwhile, value investors often take a contrarian approach. They may buy overlooked companies with solid financial foundations, durable competitive advantages, and market prices below intrinsic value. They're not looking for gains in weeks, but are willing to wait years for the investment to reflect its true worth. Graham emphasized that value investing doesn't promise quick wealth, but it protects you from the destruction that speculation can bring. Warren Buffett summed this up perfectly. Stocks aren't a game where people with IQ 160 beat people with IQ 130. What you need is the temperament to control your emotions and not become your own worst enemy.
Part 5. Portfolio and Balance. Benjamin Graham believed that one of the most important principles of becoming an intelligent investor is maintaining balance in your portfolio. In other words, you shouldn't put all your money into stocks, nor should you keep everything in bonds or cash. Instead, allocate your assets wisely so you have both growth potential and protection when the market gets volatile. He suggested a basic formula: 50% stocks, 50% bonds. Depending on your risk tolerance, this ratio can shift. For example, 75% stocks and 25% bonds for someone willing to take on more risk, or 25% stocks and 75% bonds for a more defensive investor. The key point is that you should always have a portion of your assets in something safe, so you're not completely wiped out if the stock market crashes. Take the 2008 financial crisis as an example. Many U.S. investors had all their assets in stocks and lost 40 to 50% of their value in just a few months. But those who kept a balanced portfolio with some government bonds or high-quality corporate bonds significantly reduced their losses and were able to stay afloat, ready to seize opportunities when the market recovered. Graham's reminder is clear. No one can predict what the market will do tomorrow, so maintaining balance in your portfolio is like wearing armor. It protects you from unexpected shocks. That's how an intelligent investor survives and thrives over the long term. Part 6. Discipline and Psychology, the investor's greatest enemy. Benjamin Graham emphasized that an investor's greatest enemy isn't the market, it's their own emotions. Greed when prices rise, fear when they fall. This cycle leads many people to buy at the top and sell at the bottom. He stressed that to become an intelligent investor, you must learn to control your psychology. Investing requires discipline, sticking to your strategy rather than letting short-term emotions take the lead. A disciplined investor patiently waits for opportunities, buys when prices are below intrinsic value, and is willing to stay on the sidelines when the market gets overheated. We see this in action every time the market swings dramatically. When stocks plunge, most investors panic and sell, fearing even greater losses. But those who keep a cool head realizes that it's precisely during market panic that the best bargain opportunities arise. Graham's lesson is clear. Smart investing isn't about trying to predict the market, it's about mastering yourself. If you can maintain discipline and control greed and fear, you've already overcome the toughest challenge on the path to becoming a successful investor. Part 7. The final lesson. Smart investing is patience. As the intelligent investor comes to a close, Benjamin Graham leaves us with a simple but profound message. Smart investing isn't about getting rich quickly, it's the art of patience. He believed that the market will always have its moments of madness, booms followed by busts. But the greatest rewards go to those who can wait, who place their trust in intrinsic value rather than chasing short-term swings. Patience not only helps you avoid rash decisions, but also allows you to witness the power of time,
when compounding and gradual accumulation build lasting wealth. This message is just as relevant today. In a world where everything seems to demand fast, from news to profits, it's the slow and steady approach that sets you apart. The intelligent investor doesn't need to predict the future perfectly. They need to stick to their strategy, wait for opportunities, and trust the process. So, if you want to become a true intelligent investor, remember this: patience is your greatest strength. Thank you for watching until the end. I hope these lessons from Benjamin Graham help you stay grounded on your investing journey. Wishing you clarity, patience, and good fortune in every financial decision. If you found this video helpful, hit like and follow the channel so you won't miss the best book summaries on investing and personal growth. See you in the next video.